Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, June 18th, and you're, of course, tuned into On Trend. Today, we're going to show you how to rank sectors and industry group ETFs by RSI. We're going to look at biotechs again as they join medical devices with a breakout. We'll go over healthcare and biotech stocks, and we'll talk about pullbacks that overextend. So I'll start with an overview of the broader market. We'll look at the S&P 500 and then the major index ETFs for a short-term view. Now, it's going to be tricky the next few days because, of course, we have this stupid Fed meeting. And I say it's a stupid meeting because it just causes a lot of noise and volatility. And, as far as the Fed is concerned, the market is going to do what it wants to do regardless of what the Fed says. Now, short term, we'll get the noise, but the longer term, we'll just keep an eye on the bigger trends at work. And so the most important trend, of course, the S&P 500, and it turned bullish there in February, mid-February, when the bulk of the evidence turned bullish, and it stayed bullish. So we got the 20-day moving average in green above the 200-day, which is in red. We had two lows there in that 2720, 2750 area, and that big 5.4% surge off this support zone that I'll call it now. So, if we go below 2720, then we have some longer term issues to be concerned about. Now, one thing that is possibly taking shape here, and if you're bearish right now, you got to think of what is the alternative, because the bulk of the evidence is bullish on this chart. And you can say, whoa, yeah, there's resistance here. And I do say that with a bit of sarcasm because there's always a resistance level. Well, usually, unless you're at a new high. But I mean, come on, we hit a all-time high there in late April, early May, 20 days above the 200-day, prices above the 200-day. So there's more bullish evidence than bearish evidence. At the end of the day, we have to weigh the evidence. Now, there's a potential pattern taking shape here, and it could be a big cup with handle. And that, of course, was developed by William O'Neill, and it is a bullish continuation pattern. So you got the big cup forming from October until April, and then you have the handle taking shape now. And if we break out at 2950, that argues for a continuation of the big bull market. So that's just something to consider. So looking at SPY, QQQ, and IWM, the big three, they have basically gone nowhere the last 5 days. So, first we had this big advance, 5% or so in 5 days, and now we've moved sideways with a very tight consolidation. And I don't usually use the 50-day as support or resistance in general, but when it comes to the S&P 500 and SPY, which is, of course, the proxy for the S&P 500, I think a lot of people are watching the 50-day. So, if we close below that 50-day and below last week's low, that's going to be a short-term negative, and maybe we'll pull back into that 282 area, 2800, 2820 on the S&P. The other alternative is, maybe it's a little pennant formation and a breakout from the pennant's going to be bullish. But keep in mind, the Fed is meeting on Tuesday, announcement on Wednesday, so expect a bit of volatility. Looking at the NASDAQ 100 ETF, a similar situation. We can see the channel breakout there with the big surge, and then basically a 5-day stall. It could be a high and tight flag, and a breakout from that stall would be bullish. And then if we look at IWM, the Russell 2000 small cap ETF, we can see a channel breakout, and that breakout is holding. Okay, we haven't gone anywhere for 5 days, but the breakout is holding, and you can see we're reversed near that 50% retracement. So I would treat that breakout as bullish unless we close below 148. Now, there are a zillion ways to measure relative performance. Okay, maybe not a zillion, but there are 5, 10, a dozen ways to measure relative strength when it comes to sectors, industry group ETFs, and stocks. And what I've got here is I've got a chart list that I've created, and it's got SPY and the 11 sectors. And so I can easily manipulate this chart list to do different sorts to rank performance in certain ways. So I'm viewing this in edit format, but if I click and I view in summary format, now I can see the performance in a different way. And I'll shift that over just a little bit for you. And what we got is intraday, but I can change this and I can go year to date. And so we can see year to date performance, and this is total return, which includes dividends. We can see the biggest winner is the REIT ETF, XLRE. It's up 23.7%. And there you can see I'm sorting by that percentage change. You click on the column heading and you can sort it. And we can see we got technology, consumer discretionary, communication services. All right, year to date, those are the next three top performers, industrials and then staples. And then, utilities is way down here, and healthcare is the worst performer year to date. But it's not the worst performer shorter term, and I'll get into healthcare later. And we can also use this drop down on the left, which you can't really see, but trust me, it's there. I'm changing this to a 3-month sort, all right, to see who's performing the best over the last 3 months, staples, REITs, discretionary. And then if we do it over the past month, look at that, materials jumps to the top, and then REITs and healthcare is near the top when you sort by performance over the past month. Now I'm going to switch to candle glance. So I've got view list as, and I'm going to candle glance now. And so I'm going to get up to 30 candle glance charts per page. And what I've done is I've created a custom candle glance style, and that will be my style for candle glance charts whenever I use them. And so you can see here I've got SPY, I've got the 200-day moving average, and the SPY:SPY ratio. Well, that doesn't make sense. It's 1. But the reason I'm using the ratio is you can see I've got consumer discretionary, the XLY:SPY ratio for the second chart there, and then I've got the XLK:SPY ratio for the other one. So it automatically changes according to the main symbol. It shows it relative to SPY. Now, I'm not a big fan of the price relative. I use it sometimes, but it does have its drawbacks. And what do I mean by that? Well, if you look at some of the leading sectors, all right, we can see that we look at utilities. All right, utilities have hit new highs throughout the year, but you can see they're at a new high now. They hit new highs in May and June, but the price relative is still below that December high. When we look at REITs, all right, we see REITs were hitting new highs here, and their price relative is hitting a new high, so that one's in line. But you can see when it was hitting a new high, the price relative wasn't in February and March and April. It wasn't until May that the price relative started hitting new highs there. And then if we look at staples, staples are hitting new highs, but the price relative is not. So price relative rewards volatility is what it does. And XLK and XLI are more volatile, and so they will tend to be more rewarded when it comes to the price relative and making moves. So you can see XLK, that price relative there, hit a new high along with the ETF there in late April, early May. You look at consumer discretionary, the price relative hit a new high. So what are the alternatives? Well, the alternatives are I can go to a normal candle glance style, and I can go 6 months, and I can add an indicator, and then I can sort by that indicator. So I could add the scooter and sort descending, and that'll put the strongest scooters at the top. And we can see at the top we have REITs, all right, so that matches. But we also have consumer discretionary, and it's not trading at a new high. And we have technology, and it's not trading at a new high. And then we get to utilities, which are trading at a new high, staples at a new high, materials not at a new high. So there's, something not quite right with the scooter. It's a good ranking, mechanism when you got a little volatility involved because it's based on a large part on the percentage above the 200-day moving average. But what I'm trying to do here is take out some of that volatility, kind of have a volatility adjusted relative strength. And what I would suggest is something like RSI. And I wouldn't suggest 14 days, something a little bit longer, say 65 days, which is 3 months. And then we can sort by RSI, and we can see this more jibes with the price action because the relative strength index, it measures the relative gains. It measures gains relative to losses for the individual ETF. And because it's using the gains from utilities relative to the gains from the losses from utilities, it keeps it in check. It's kind of normalized in that regard. So it takes away that volatility component. And so you can see here, we get the ones that are leading here, the real leaders. REITs hitting a new high, and they have the highest RSI value, 60.29. We can see Staples, 58.57, and they're hitting a new high, the second highest RSI value. And utilities, the third highest RSI value, and they are hitting a new high. So I think this more jibes with what's happening on the price chart. All right, and then we go further down, we can see that healthcare is in the bottom half as far as performance because it's not hitting a new high. All right, we need to get above that high to get more momentum going. Energy is the weakest, and that's reflected on the price chart and in the lowest RSI value. It's the only one below 50 there. It's at 46.33. So it is clearly the weakest. So I've got a chart list that has 40 industry group ETFs that I follow, and I'm showing these in candle glance format, and I've got 65-day RSI, and we're sorted by 65-day RSI to see the leaders as far as these industry group ETFs are concerned. And there you can see, of course, the Vanguard REIT ETF hitting a new high. So it's one of the leaders. Here's the Pure Funds Electronic Payment ETF, iPay, and it hit a new high here in June. Strong RSI above 55. We can see insurance trending higher, so it's very strong. And then when we look down, we can see a new entrant in June here. We have gold miners there, making a debut at number 5. In defense is still strong. Look at this advance here in the PPA, the defense ETF. So it is looking good. And medical devices got that nice triangle breakout. So it's clearly one of the stronger ETFs. Then when we kind of scroll down, we can see housing hitting a new high. Solar ETF hit a new high. There's another defense ETF hitting a new high. And then to go down to the bottom to see the ones that might want to be avoided. All right, I can change this sort from descending to ascending, and that will put the lowest RSI values at the top. And we can see these are pretty much the ones you want to avoid, or at least I want to avoid. I'm not a bottom picker. We can see the energy ETFs dominate the top 3. Oil and gas equipment and services, natural gas, and oil and gas XOP. That is the exploration and production ETF. And then we can see metals and mining and steel. So I'm just not interested in any of these ETFs and retail. Now, even if you don't trade these ETFs, I think you can get valuable information from this in that these are some of the ETFs or groups you want to avoid. If you want to look for strong stocks, you're probably going to have to look elsewhere. So, banks are not on my list of stocks to look at. You see the KRE ETF, it's got a lower high there in May. And then the big bank ETF, KBE, has just gone nowhere. So there's no trend really here to speak of. And so that's why I would avoid those. So one of the biggest developments over the last 2 weeks or so has been the resurgence of the healthcare sector. And first we saw medical devices making big moves. We saw some select stocks from the healthcare sector making moves. And we saw biotechs make big moves yesterday. So let's check in on this. So first, I've got a weekly chart for the healthcare SPDR XLV. And you can see it's gone nowhere, basically, for almost a year. It peaked there in September, October. That looks like September. And we formed a triangle consolidation. And we got this big move up 3 weeks ago, small gain yesterday, but we're breaking above that triangle trend line, and it looks like we're getting a continuation higher signal. And this is the high from April there, and there are not a lot of ETFs and stocks trading above their April highs. That's kind of a benchmark high. So if you're trading above that April high, you're showing some relative strength over the last 1 to 2 months, relative chart strength, that is. So this looks like a big consolidation and a big breakout to signal a continuation of the bigger uptrend. And we can see in the indicator window, I've got the PPO 426.0. You see the settings over there on the left. When you set the last parameter at 0, then you get this histogram here. So this is the difference between the 4-week EMA and the 26-week EMA. And it's not a perfect indicator. It's going to have whipsaws like all moving average signals. You can see here we got a signal in January, and it turned into a whipsaw there. We got another signal now with a positive turn here in June as we're breaking above that triangle line there. So I think healthcare the cup is clearly half full for healthcare. So if I ran my screens, especially last week, biotechs would not come to the top of my relative strength screens. They would be near the bottom. They wouldn't be at the exact bottom, but they wouldn't clearly be up there with the likes of the defense and the gold and the insurance ETFs. But I highlighted biotechs last week because this is a subjective assessment, let's face it. All right, I took a look at the chart and I saw a setup, and I've seen this setup before, and I've seen it work before, and I've also seen it fail. I mean, keep in mind that just because there's a setup there and I'm pointing it out, it doesn't mean it's going to succeed. We're all wrong at some point. But this one appears to be succeeding now. So here is IBB, and what I saw here, and I pointed out in the video on Thursday, is we had, a nice big advance. And then we had a decline that formed a falling wedge. And we started getting support here in that 100-102 area for several weeks here. It's like 4 weeks we firmed in that area. And we edged above the wedge line. I wouldn't call that a real breakout. I draw the lines to show you the pattern, to say that it's, typical for a correction within a bigger uptrend. And in addition to the pattern, the retracement was typical. So I was putting a number of things together. We had a big move. We had what looked like a correction in the wedge. It retraced the right amount, 50 to 62%, and the ETF started to firm. So those three things put me on alert. And now we've got the breakout here with the move above resistance. So I would take that as a bullish move for biotechs and reevaluate on a close below 102. Now IBB, as you can see from the holdings on the right, is dominated by the big biotechs. Top 10 account for 53%. The next one, XBI, is a broader based biotech ETF, and we can see that its top holdings account for just 19.3% of the ETF. But we still got the same pattern. We got the big advance, we got the wedge decline, and we got the wedge breakout now. And XBI started firming a little better here over the last few weeks. And there's the price relative. And I said I don't use it all the time, but I think on a short-term basis you can use it. I think longer term it's not that great of a measure for relative performance, as you saw from that utilities price relative. But, shorter term, we got this pullback and it's slowing, and now we're turning up, and it looks like XBI might be poised to outperform IBB. So here are a few healthcare names to watch. This is Apellis Pharmaceuticals. It's a biotech that had an IPO. So that's why you can see the 200-day is not starting there until August. That's when you had 200 days of trading in August 2018. But we can see here that, clearly there's some sort of base there and a resistance zone. So I'll go ahead and take my timer off there. And you can see there's a resistance zone. And then we had two lows here in that 12 to 13 area, a big surge and a consolidation. And that consolidation formed what looked like a bull flag type pattern. And we got the breakout there. So I'll remove those patterns there and I'll just leave the bull flag. But the bull flag is the active pattern here. And that breakout is bullish. And you can see here, your stops, if you have a stop at 17, that's quite a ways below 21.86. So it's not one for the faint at heart. Here is Bold, which is Audentes Therapeutics. I have no idea what they do, but we can see some sort of inverse head and shoulders pattern and a big breakout. It wouldn't have made my screens until up here in April and May because, it didn't have that big move and it wasn't showing strength for long enough. I need at least 3 months of strength. But if we look at the pattern taking shape here now, it's kind of a big surge, 18 to 38. It doubled and then it consolidated and now it looks like it is breaking out. Here's a duller one. This is HCA Healthcare. And the reason I highlighted it was because it's in the pharmaceutical sector, but it looks like we've got a breakout there working. So we had this, big surge, we have a consolidation, and we're breaking out here. And if you're not sure what something looks like on the daily chart, you need to just go back say to a weekly chart. So I have moved this over to the Sharp Charts workbench and I'm going to go to 3 years, high-low close bars thick, and go to weekly to see what this looks like on a longer term perspective. And so you can see on a weekly chart, it looks much more constructive in that, you had the big advance and then we had a long correction. So long corrections do happen several months. But then we got this monster advance from October, November 2017 all the way to October, November 2018. We doubled. And since then we've been, it's a choppy range. It's probably some sort of a corrective pattern. I can't draw any lines that match up there, but I think if you look at the gist, you have a big advance and some sort of a corrective move. And then if you go back to the daily chart, you put that into perspective and you can see that, okay, so if I say that this is just a big corrective move here, then I look within the correction and I'm trying to trade the pattern within the pattern. So I say, okay, the weekly chart suggests that this is a correction and we've got this big surge. And now we got a consolidation breakout in the works on the daily chart. So that's kind of adding timing or tactical moves to strategic moves. Strategically, it looks like a long-term uptrend that was correcting. Tactically, we've got this breakout on the daily chart. So now we have Insight, and I've highlighted this one before, and it's not for the faint at heart either, but you can see this this breakout zone, and you got to give big zones to biotechs, but we had that big surge, and then we had a consolidation, triangle it looks like, and now we're surging off triangle support. So Insight could be headed higher. And Vertex, and this is another one where probably a weekly chart will do it more justice. So I'm going to back that out to 3 years, high-low close bars thick, and then click update so we can get some perspective on what's going on here. So that looks just a bit different on the weekly chart. And on the daily chart, it can be frustrating, but if you look at it weekly, it's just a consistent move higher. It's a choppy move higher. And what we can see is we can see higher lows coming in, and this could be a higher low coming in. And then you can see we're consolidating in a very tight range. And if we get a consolidation breakout there, that is going to be bullish for Vertex Pharmaceuticals. So I've got a real love-hate relationship with the 200-day moving average. In general, it gives you an idea of the overall trend. If you're above the 200-day moving average, chances are you're in an uptrend. If you're below, chances are you're in a downtrend. But as far as a support or resistance level is concerned, it's not that good, especially when it comes to individual stocks. Maybe for the S&P 500 it works, but for individual stocks, it's just all over the place as far as a support or resistance level is concerned. So don't even use it for that as far as I'm concerned. So when you look at TJX here, and this is one I've followed and I've put in don't ignore this chart, there you got the whipsaw around the 200-day there, and we got a break above the 200-day, and then we had the flag. And what caught my eye was the flag at the time, which is a bullish consolidation after a sharp advance, and we continued higher. And then I highlighted the stock here when it was above the rising 200-day, and it moved on to new highs. Then it got hit really hard. And here's the thing, you get this huge decline, which is basically an outsized decline. It's one of the bigger price declines this year. And you can see you break below the 200-day. And what happens? Well, you stall and you move right back above the 200-day. So this is one of those examples where if you look at the pattern that was taking shape, we had a nice falling flag type pattern working here. And then things kind of got out of shape when we broke below the 200-day. But a break below the 200-day is not always the bearish development. All right, we got to keep an eye on the bigger trend at work. And if you look at what was happening here, TJX was up from 41 to 55, so it was entitled to a correction. And we can see this kind of resistance level turning into support. And so I would watch, broken resistance turning into support, key retracements and such. If I put this on here, I would use those instead of the 200-day. Now, key retracements are also kind of like hand grenades. They're not pinpoint in accuracy. It's not a sharpshooting exercise. You get to that 38 to 50% area and you put things together. You got broken resistance turning support. You're into that 38 to 50%. You're oversold. You can see that if you scroll down, RSI moved below 30. So then you have a different kind of setup. It's called a mean reversion setup. It's the opposite of a breakout setup. But things were aligning. So you got this indecision, you got the bounce, a little bit of a throwback, and then you got another bounce higher. So I would say TJX is bullish here. The cup is half full. Maybe there's a bigger cup with handle taking shape even. And that concludes this edition of On Trend. Thanks very much for tuning in and have a great day.